Nigeria, making finance a force for good.
Good morning, and thank you all for joining us this morning for the Level 3 Revision Bootcamp. This bootcamp will focus on exam strategy, constructed essay response techniques, and practical tips for the exam day, knowing that your exam is close by. Some are having it next week. So based on popular demand, based on the meeting we had last week, we'll be revising derivatives and portfolio management pathways with additional topic areas that will be covered, that will be depending on the facilitators' availability. We're still looking for facilitators for those other areas. But today we'll be taking derivatives and also portfolio management pathways. As at 9 to 10, Olawale Keshiro, CFA, will be taking us on derivatives. And from 10 to 12, we'll be having Chukwuka, Ezone CFA, taking us on portfolio management pathways. I hand you over to Olawale Keshiro for his session. Thank you very much and welcome.
Okay, good day, everyone. Olawale Keshiro is my name. So as we all know, my focus will just be on questions. So what I've done basically is I have several curriculum end of chapter questions here that we will answer together. Then we discuss the exam techniques. It's just a minute. Okay, so let's get started. So I have here several curriculum questions. I'll teach us how to answer the questions directly on the exam day. So here, this is, I'm sure some of us should be used to these questions. And the first thing to notice, as far as the exam is concerned, especially for constructed response, it is expected that you answer what you are asked. If they ask us, what's the cost strategy for a particular covered call, just go straight directly to the answer. You do not need any long story. So let's get started with this. This is strategy one. I'm sure some of us are used to it already. Strategy one will require N to buy what. So the first thing to note here is this is more tilted towards synthetic replication. And if you recall, even at earlier level, when it comes to synthetic replication, a better way to recall synthetic replication is this. Just recall your put-call parity formula. As far as put-call parity formula is concerned, at this level, you are not expected to struggle with it. But there's an easier way to even recall the put-call parity formula. Today, you have the stock. Then in future, you have exercise price. So the first step for any type of investor is to protect the downside risk. So if you want to protect your downside risk, what type of option will you buy? Is it a call option or is it a put option? It's obviously a put option. So to protect downside risk, you buy a put option. Now, to benefit from your upside, what do you buy? A call option. And that's your put call parity. So a put call parity formula is S naught plus P naught will be equal to C naught plus X. Obviously, S naught is as at today. P naught, that's the put option price today. C naught is the call option price today. So the only one that is not as at today is exercise price. So you need to discount this back to today. So I can write this as the present value of X. Now, what are we replicating? If you go back to the question, this is strategy one. It says strategy one requires what? So strategy one is all about constructing a synthetic long put position. So a better way to write this out is S naught is equals to P naught, which we call protective puts. I'm sure we'll get to a question of that nature shortly. will be equal to the present value of X plus C naught. So I need to make long put the subject of the formula. This is long put A. So you could have been asked to make to replicate a short put, but here we're asked to replicate a long put. So if you're asked to replicate a long put, your focus will just be on plus P naught. So P naught is equal to the present value of X plus C naught, then minus S naught. So looking at this, going back to this strategy, strategy 1, which is all about replicating a long put. And if you notice, this is plus. It must be plus because we're interested in replicating a synthetic long put. If it was replicating a synthetic short put, then you need to make negative P, not the subject of the formula. So with this now, what does this mean? This implies that you would go long call. You go long call at this exercise price and you go short stock. So you go long call at this exercise price and you go short stock. It is now worth noting on the exam day, this is not acceptable, especially for constructed response. If you are to write it out, if they should ask us for, that's essay type of question now. If they should ask us for the replication of long put, what you need to write out there is not this put call parity formula. What you need to write out is you go long call at exercise price of X, wherever the X is, and you go short stock. So you go short stock. So back to this question, which is an end of curriculum chapter question. You can almost guess the answer already. So you would go long what? So strategy 1, which is about this, you go long call. We have the long call here, and you go short stock, even though there's no short stock here. So what we have here simply means, so you are going long stock here. This will be false. This is false because what you are replicating is a put option. So you go long call. So as far as this is concerned, the right option is option C. But for constructed essay question, you are not expected to write down your put call parity. We don't need that. We need applications as far as the exam is concerned. So let's move on to the second question. So as far as this second question is concerned, what is strategy 2? So if you look at strategy 2 here is buying. So this is buying 100 shares. The bottom line is you are going long stock. Then you are writing a call option. So if you are going long stock and writing a call option, for some of us that are used to it already, we know it's a covered call. So it's a covered call. And this is a logic. You have sold a call option. If you have sold a call option, selling a call option means you must be a rich institution because the stock price could move to $1 billion overnight. So you must be a rich institution. So in order to protect yourself against the risk that I just talked about now, what can you do? You can buy the stock now. So you are covering the naked call that you have sold. So to cover the naked call you've sold, what will you do? You buy a stock. So you have a stock, you are long the stock, so that when you get to expiration and you have to deliver on the call you sold, what do you simply do? You deliver the stock. So, and this is a strategy at least to hedge your risk against not being able to deliver your position as far as the long call is concerned. So, as far as the short call the call option you sold is concerned. So back to this. For this, we've ascertained that it is a covered call. But if you look at this question, based on Exhibit 1, this is Exhibit 1A, and should expect strategy 2 to be least profitable if what? So the first thing to note here is what are we expected to compute? So what we expected to compute is simply the break-even. If you can compute the break-even will let you know when your revenue will be equal to your cost. So any amount below the break-even, then you technically speaking know that you would not be profitable. So what they basically requested for here is your break-even. But before then, I also know that some of us struggle with covered call, how to recall, maximum gain, maximum loss, and so on. So I'll briefly go through it. So for a covered call, the first thing is, what's the cost strategy or the cost structure? Maybe that should be a cost structure. Recall I said you have sold a call option. So if you have sold a call option and you are scared that you might not be able to deliver that naked call in future, because if the stock price should go up, you might struggle to deliver on your position in future. So what can you do? What you can easily do is buy the stock today. So you bought the stock today. Please, this is costs. Because it's cost, you've paid for the stock. So we're looking at this from the perspective of costs. So you have paid for the stock. If the stock is $100, you've paid $100. Now, you receive premium from the call option that you sold. So let's say the premium you receive, the option premium you receive is $2. So technically speaking, your cost is 98. So I'm only trying to justify why this is plus, because we're looking at it from the perspective of costs. So this is the cost structure for a covered call. What's the break even, which is what we're actually looking for in that particular question. Break even is I have spent $100 at the beginning. I will be at a break even level when I have revenue of $100. So that makes it relatively very easy. Since this is my costs and that's the amount I spent, then my break even would be exactly the same. So I need to make a revenue of this. From the example I gave earlier, this was 100 and this is 2. So my cost is 98. At a break even level, I should make exactly 98. That's my break even. So I will expect my break even to be equal to my cost. So this is technically saying if I make a revenue of this and it simply covers my cost. So that's break even. Then the next question, which is the question we were asked to compute there, the next question that we could be asked on the exam day regarding this cost structure. I know a lot of people are good with cost structure. They are fine. They've committed it to memory and so on. But there's a big issue here. The examiner could request for delta, that you should compute the delta of a covered call. So to compute the delta, most of the time, people even struggle to know what the delta of a long stock is, what the delta of a short call is, and so on. And a better way to recall is this. So delta ranges from +1 to -1. The long call will have a positive delta. Let me use this as minus, and this is plus. So long call will have a positive delta. Then long put will have negative delta. I will explain the rationale to recall on the exam day. So at the money, long call, that's +0.5. At the money long put, that's -0.5. So as you move towards 1, you are in the money. And this will also be helpful for currency management. So as you move towards 0, you are moving towards out of the money. Now, for short call, the short call's delta is negative, while short put delta is positive. I will explain the rationale. So you don't have to climb this, and this is the logic. A long call will gain, will be happy, will have a positive value when prices are going up. So if prices are going up, a long call will be happy. So you will expect its delta to be positive. There's more to it, but at least since our exam is closer, a better way to recall is a long call's delta will be positive because as stock prices are going up, a long call is happy. But a short call will not be happy when stock prices are going up. A short call will be happy when stock prices are going down. That is when the market is in a negative. And that's how to recall. For a long put, when stock prices are going down, a long put is happy. So that means you will expect the delta of a long put to be negative. A short put would be happy when stock prices are going up. That is when the market is in positive. Then you will expect the delta of a short put to be positive. And that's how to recall. So on the exam day, they could ask us, even though we've computed what we needed here, for a covered call. On the exam day, they could ask us for the delta for any, they could ask us for the delta of a straddle. If they ask us for the delta of a straddle, they would have given us, they would, on the exam day, they could give us, we know a straddle is long call, and you are also long put. And let's not forget the difference between a straddle and a strangle. So a straddle is you buying at the money call and at the money put. While a strangle, just like the name, like strangulations. So a strangle is you buying out of the money call and out of the money put. And this is particularly important when it comes to currency management, especially let's say we are dealing with a 25 delta option. So if you buy a 25 delta option, which is the same thing as 0.25 delta for both your call and put, and let's don't forget that for put, if you are going long put, it will be negative. So the bottom line is just the fact that we need to be fine with delta. And it's not even just delta alone. You could be asked to compute the gamma of a cost structure. And it's also worth noting that for long call and long put, their gamma is positive. So, but for short call and short put, their gamma is negative. So back to this. So for me to compute the break even, what's the break even? We just talked about it now. It's C naught minus, it's S naught minus C naught. What's the stock price A? So as far as the stock price is concerned, this is what we are dealing with. We are dealing with this. So stock price. So my stock price A, so I have IZD, then we have the call. So we are dealing with this IZD. The exercise price, the strike price is this. So we have it there. So look at call premium. We have put premium. We don't need put premium. What we need is call premium. So if that is the case, this is it here. That's 2.67. And we have this as 93.93. So if you do it, even me looking at it, I already can guess what the answer is. The answer will be A. The answer will be A because this should be less than. So the answer will be A, and we can move on to the next. So now moving on, strategy 3, we have another strategy here. Fortunately, we've answered this, so I'll skip this. We know here directly they are requesting for a break-even position. But before I also move on, I'm also aware of the fact that most candidates struggle to know how to bring out the answers for maximum call, maximum put, and so on. So I'll demonstrate a logical way to recall without using graphs. I know some tutors use graph, but for me, I think using graph could be complicated. So looking at a covered call, let's start with the cost structure. A cost structure is this: S naught minus C naught. We are certain about the break even, so we are good to go. Then value. The next thing to note at this level, especially level 3, is value is not the same as gain. Value is not the same as gain. So value is you are considering your benefit on the day you're exercising without considering premium. Option premium is not considered. So if the examiner should ask us value, please, you should not incorporate premium. Gain, profit, or loss is now when you now start talking about premium. Please. So at this level, it's worth noting that we should be able to differentiate value and gain. Value and profit are not the same thing. So value could also be called payoff. So if the examiner should ask us compute the payoff, then I believe that we should be good with it. So to compute the value here, the way I want us to look at it is this, to make it easier to recall on the exam day. You have your S naught. S naught at expiration, what will it be what? It will be what? S capital letter T. If you recall from even lower levels, time T equals to 0, this is the expiration of the contract. You have stock price A at initiation, then A at expiration is S capital letter T. That's the stock price at expiration. Then I bring this down, that's minus. Then your call. What's the value of your call? Value of your call at expiration. Yes, you could have paid certain amount of time at time T equals to 0, but at expiration, it is a maximum of ST minus X, comma 0. And that's your value. There's nothing to, that's the value. That's the value at expiration. Using the same logic to compute profit at expiration. So profit at expiration, how do you go about this? So it is your value first, which is st minus maximum of st minus x, comma 0. Now then minus your cost. How much did you spend when you... So you could have computed your cost here and just insert it here. Or you could write it in full, whichever one you are fine with. That's S naught minus C naught. And if I want to expand it, it will simply be ST maximum of whatever, then you can complete it. Now, where people struggle is now differentiating between maximum, if I showed. So where people struggle is differentiating between maximum profit, maximum loss, and profit at expiration. We've just computed profit at expiration. And what we got was ST minus maximum of ST minus X, comma 0. Then if I expand what I've done, that's C naught minus S naught. Now, maximum profit, and we can use the same logic all through, even for protective puts. So for maximum profit means if the stock should start performing abnormally well, and the stock price keep going up and up and up and up. If the stock price keep going up, what will happen? This would be up, really up, 1 billion, 1 trillion. So this will still be in existence. But if I'm dealing with maximum loss means the worst that can happen to the stock. What's the worst that can happen to the stock? The stock could be worth 0. That's the worst that can happen to the stock. Look at what am I doing? I started my whole explanation from maximum. I started my own whole explanation from profit at expiration. So ST, this is ST, the maximum loss is 0. I bring this down, that's minus. If the stock should perform really well, what will happen to this? The stock, this will obviously be exercised. And that's ST minus X. But if the stock should worth 0 when you want to exercise, what will happen? It is this we'll be talking about. Then minus your cost. We can just put in minus cost. And we are good. So we can use the same logic for protective put. We can use the same logic for others also. So that's that. So moving on. Here, strategy 4. What's strategy 4? Protective puts. What do they want us to compute? Maximum loss. So for protective puts, maximum loss. So the first thing is when it comes to protective puts cost structure is S naught plus P naught. So it's like buying an insurance on your house. First you have the stock, then you bought an insurance on your house. So if anything happens to your house, you are rest assured that you are covered. So this is just more or less like buying an insurance on your house. So with this now, the break-even is easy, is exactly what you have here. So the break-even is easy. So for the maximum loss, so that I don't waste so much time, I'll just write it out. Maximum loss is simply S naught minus X plus P naught. So, and please, let's not forget, on the exam day, if you have computed it somewhere, you can put your answer. You can put your answer directly. And if the answer is B, you put your answer there as B and you move on from there. But however, it is a very risky strategy. It's a very risky strategy because you would not get any partial mark. So as far as the exam is concerned, if it is a calculation question and you are 100% sure you are fine with the answer, just put your answer there. If your answer is 100, they give you your full mark. Even if it is 5 marks or 10 marks, they give you your full mark. However, if you are not too sure, then you will have to compute it. You would have to compute it so that you can get 1 or 2 partial marks from there. So with this now, what's going on here? So as far as this is concerned, this is our focus. It's QWY. What's S naught? So I have my S naught. My S naught is this. That's my S naught, which is this. That's 28.49, then minus X. So what's my X here? What am I dealing with? I'm dealing with strike price of 25. This is 25 here. So if that is the case, I have this settled. So my X is 25. Then P naught. So P naught, this is call. I don't need this. This is call premium. What I need is put premium. So as far as put premium is concerned, this is it here. Then it will be plus 0.50. So if you solve it, I think you should have B. Okay. Now, number 5. Number 5, what strategy is number 5? So here, this is now where we need to be very careful on the exam day. There are some answers that no one that has prepared should ever choose on the exam day. Personally, if you have prepared for the exam, you should never choose the answer. First of all, they started the whole scenario with buying shares. Estrado, you don't buy shares in Estrado. So this is completely wrong. It's not possible. You don't own a share in Estrado. As far as Estrado is concerned, you don't own a share. Even in a bear and put, you don't own a share. So if you don't own, when I'm sure in 2-3 slides from now, we will discuss bear and bull spread, and we will discuss it slightly extensively. However, you don't own a share. So if that is it, why should I keep reading? I'm not going to keep reading this on the exam day. If it's an MCQ question, why should I keep reading? I'll just choose my answer and I'm 100% sure. But for the sake of this revision, I will go through it. What's a collar? As far as a collar is concerned, originally you own the stock. The stock is worth, let's say, $100. So you own the stock. Owning the stock, your aim is that the stock will not perform well. That's your belief. You do not expect the stock to perform. You expect that the stock price will go down. That's what you expect. So you decided that you want to buy an insurance. However, you are not buying the insurance at this $100. You are still fine losing maybe $10. So you started buying the insurance around $90. So your insurance is from $90 downwards. So your insurance covered this portion A. That's when you're buying the insurance from 90 downwards. But you didn't buy any, so you're not protected here. Your insurance does not, because you did not buy the insurance at the stock. And if you look at what's going on here, that's exactly what's going on here. This is 28.49. Now, the guy bought protection at 24. So protection is at 24. That means this investor is not protected here. The person is not protected here. So the person bought protection from 90 downwards. So the person is protected from 90 downwards. That's one. Then number 2, this guy now the investor wanted free lunch, because the expectation is that stock price will come down. So to get free lunch, the guy now decided, as the investor, decided to go sell call at maybe exercise price of 105. So free lunch from here, that reduces the cost, because originally the person owns, that's the investor now, the investor owns the stock, paid premium, that for this protection, that's put option premium, then to reduce the cost, now sold a call option. So, and that's what is being explained there. If you look at what's going on here, this which is 28.49, then put at what, 24, put at 24, this is 24. Please, let's be careful with this type of question, especially if they want us to compute the cost structure on the exam day. People often mix it up. So, which is this, that's 24. So if you need the premium for the put, this is what you would use. Now look at the call. The call is at 31. If you need the premium for the call, this is what you will use. So let's be careful on the exam so that you don't mix it up together. But the answer here still remains option A. So that's that. I want to maximize this particular revision class. Now, there is now one very big part a lot of people struggle with. People struggle with bear spread and bull. In the CFA curriculum, the focus for bull, they focused on call. For bear, they focused on puts. Even though there could be call, we could have a call option and we are still dealing with bear. We could have a put option and we are still dealing with bull. But let's focus on what the CFA curriculum, what they focused on in the CFA curriculum. So let's start with, I will just oppose them together so that we are not confused. So bull and bear. So for bull, it's logical. There is nothing to cram here. There is nothing to cram. Instead of, if we're in a bullish market, what do you want to do? What you technically want to do is buy now. You want to buy now and go and sell later. If you expect that the market will stock prices will keep going up. And that's what we want to use derivative to do. And in the curriculum, they focused on call option. That's what they focused on. So we want to use derivative to do this exact same thing. So let's say stock price is currently, the stock price is currently at, let's say, $10. You can buy at 11. So you want to buy A in a normal market, in a cash market. You want to buy A and you want to sell maybe at 15, since that's your expectation. So you buy A and you sell at 15. So if that is the case, if you are buying at this level and I want to use call option, what can make me buy using call option? I'll go long call. If I go long call, I have the right to buy. Hopefully, my expectation materializes, then I would end up buying. So here I'm buying, I'm going long call. And please, this will be much more expensive. This will be much more expensive because it's closer to the stock price. So you are buying something that is much more expensive because it's closer to the stock price. But if you look at this, the guy now as the investor want to reduce his or her cost. So to reduce your cost, what can you do? You can go and sell A. You can sell a call option. You know, normally in a bullish market, what do I want to do? I am looking at selling at a much more later higher price. And that's the same thing I'm doing. So if the stock price should go above 15, what will happen? The long call will exercise his or her rights, and the short call would be obligated to sell. So hopefully things go as planned. Obviously, there's no free lunch anyway. But hopefully things go as planned, then we are good. So you will end up buying at 11 and you end up selling at 15. And that's what we are saying here. So for a bull spread using call options now, it will be CL minus CH. So CL, that is, you are buying at a lower, which will be much more expensive than you are selling at this particular one. So you are selling at this higher, you are selling at this particular one. But where a lot of people struggle is now this, the break even. So for the break even for a bull spread, the break even for a bull spread is XL plus cost. Now, what is the break even for a bear spread? The break even, because in the curriculum for a bear spread, they focused on puts. So, and you know that for put option, how do you gain? You gain when stock prices are coming down. That's when you gain. So for a bear spread, it will be XH, that's the higher one now, because your expectation is that the stock price will go down. And you know, if you expect stock prices to go down, you want to sell here, somewhere here, you sell, let's say this is 15 and this is 10, you sell here, then you can now buy at a lower price. So you are selling here, and to be able to sell here, what do you want to do? What you want to do, let's forget about break even first. If you are using a put, so this is X, so you are selling at a higher exercise price. So you are selling A, let's say this is 15. So you want to sell A and you want to buy A. This is, let's say 10. You want to buy A. That's what you want to do in the normal market. But using derivative, you want to go long put A because you will end up selling at that level. Then you want to go short put A. So hopefully things go your way, you end up selling because long put is the right to sell. So here you end up buying it. So you end up buying, because if you are short put, the long call and the long put will exercise. So if the long put exercises, then you as a short put, you will end up buying. So now back to what brought me to this, why I had to explain this, is the break-even level. So for the break-even level here, it is simply XH, that higher price you will end up selling. But don't forget that you can only get back your money when prices are going down. So it's XH minus cost. So this is where I'm going to. And that's the whole essence of the long story. Please, let's note this and this. So for break even for bull spread, it is this. And it is this because you gain in a call option when prices are going up. For puts, when prices are coming down, it's when you gain, and that's why it is minus. So please, let's take note of these very salient points, please. Let's take note of this. Now, there is one other one, because time is against me. I thought I could do futures today. However, there is one other one I think a lot of level 3 candidates struggle with. So I think a lot of level 3 candidates struggle with this. And I will just end, I will end it with that. I think a lot of level 3 candidates struggle with it. So I will end it with, where is it again? So I want to bring this down. So that, so it's about, let me bring this down just a minute. Okay, so I'll be projecting it now. So I think a lot of, so that particular, we will just end with that. I know that could take a bit of time. So this is also from the curriculum. So I'm sure some of us will be used to this variance swap. So some of us could be used to this variance swap. But I know some people will have said, oh, I'm not going to commit it to memory, and so on. It's a long formula. And so what's the logic around it? So I will run us through how to think about it so that it's relatively very easy for us. So variance swap is what we want to talk about here. And please, this could also be, I've seen it in different mock questions in the past from the CFA Institute. So it's expected of us to know this formula. So I will start with first, before we answer this question, I'll start with settlement amount. So for settlement amount, the way I want us to see variance swap is this. So as far as variance swap is concerned, you are taking a bet on implied volatility. So you are taking a bet on implied volatility against realized volatility. That's what you are basically doing. So to compute the settlement amount, so you want to compute your settlement amount. So your settlement amount would simply be variance notional. So it will be variance notional. Maybe I should use a much more bigger. So we are here, this is time t equals to 0. This is the expiration of the contract, let's say 12 months. So here, to compute your settlement amount, so settlement amount is simply variance notional times realized variance minus variance strike. Please, I need us to take note of what's going on here. The first thing to notice, as far as your exam is concerned, in the curriculum, this should never be converted to decimals. You work with it fully. So if they give you your variance strike as 10%, once you convert it to 0.1, then you've messed up the answer. As far as the curriculum is concerned, they used absolute numbers directly. We would see it in the question we will do shortly. That'll be our last question for today, because I know it will take some time. So variance swap, when dealing with variance swap, never convert the percentages to decimals. Work with whole numbers. Work with whole numbers. So the variance notional times realized variance, then minus variance strike. Now, for this variance notional, it is now Vega notional divided by 2 times strike price. Please, this strike price should also be in whole number. So don't use, even if you are told strike price is 15%, what you are using here should be 15, not 0.15. Once you do that, you mess up all your answers. So if you are giving variance notional, then lucky you. But if you are giving Vega notional, then you have to compute your variance notional. And you have your realized variance here, which will be given in the question. We will see it shortly. Then you also have your variance strike. Please, if your realized variance is 15%, just use 15 squared. If it is 20%, use 20 squared. Don't convert the decimals. Don't convert it to decimals, please. The percentage to decimals. Use the absolute number. So once you are done with this is relatively easy. A lot of people will be fine with this. However, the one people are not fine with is the longer one, which is the mark to market. So the mark to market, so for the mark to market, let's say we are here, which is 5 months. This is 5 months. So we want to mark to market here. The contract has not ended. You know, for the previous one, the assumption is the contract has ended. So it was easy for us to do this. But here, the contract has not ended. So we are here 5 months down the line. We have how many months left? 7 months left. So we need the mark to market here. So that implies that we have realized the variance for this portion. But this portion is unrealized. So how do we go about it? Forget about the formula in the curriculum. It's all logic. So it is 5 over. So what I want to do is this. I want to compute the realized variance. So to compute the realized variance, it will be 5 over 12 because we have realized this 5. We've realized the 5, that's 5 over 12. Then times, so what has been realized, whatever has been realized volatility squared, it has been realized, but there's a portion still computing the realized that we've not computed, which is this portion here. So the portion we've not computed, that will be 7 over 12. So it's 7 over 12, then times the implied. So you have to imply that. So the implied volatility. So the whole of this, it will just give us what we have here, which is the realized variance. So what we've just gotten is realized variance. Now, minus the variance strike. So you can put your strike there. You have to square it, obviously. But we are still not done. We need the variance notional. The variance notional on a normal day will have been paid here. It's like notional principal, notional amount that we are used to in a normal swap. But unfortunately, this is where we are. We are at month 5. So if we're at month 5, how do we go about it? Since we're at month 5. So the way to go about it is we need to discount what we have here back to this portion. So whatever my variance notional is, so whatever I have here, times my variance notional, but my variance notional will have to be discounted. But the discounting is simple interest. So it will have to be discounted. So it will be divided by 1 plus the discount rate. Here, I'm discounting for how many, and this is where issues usually arises. I'm discounting for how many months? I'm discounting for 7 months because the variance notional was paid, it should be paid here So I'm discounting back here to the 5th month. So I'm discounting for 7 months. So that would be discount rate times 7/12. And please, you are not raising to, this is simple interest here, please. It's completely simple interest. So it's variance notional divided by 1 plus discount rate times 7. So once you have this, then you are good. So the question now is, let's apply what we've just done to this one. Look at what's going on here. So we have this. We are dealing with 5 months. This should be where we would focus on. So we are dealing with 5 months. This is 5 months here. This is 12 months. So in the last 5 months, what has happened? So in the last 5 months, 20% has been realized. So 20% has been realized in the 5. So the best way to get started is start with 5/12, because this portion has been realized as 5/12, then times 20%. And please don't forget that your 20% will not be in decimals. It's 20 squared. Now I need the other end to complete my realized. So the other end of this will be 7/12. Now I need what is implied. What is implied for the next 7 months? What is implied for the next 7 months is 18. So I can see that here. So it is 18. So that's 18 squared, then minus my strike price. Do I have my strike? Yes, I do. So 18 squared, I think 18 squared, I hope I'm right. I think 18 squared should be 324. This is 400. Now I need the strike price. So the strike price squared, obviously. What's the strike? We were told the strike is, where is it again? That's the original strike. So the original strike, when you entered into the contract, is 15. So 15 squared. So 15 squared, that's 15 squared. So I think 15 squared should be 225, if I still recall mathematics well. So, but we are still not done yet. Then times the variance notional. Do we have the variance notional here? It doesn't seem like we have the variance notional here. So we have to compute. So variance notional, if you recall, is Vega notional divided by 2 times strike. So what do we have as our variance Vega notional? For the Vega notional, looking at this, Vega notional, we have it here. That's this, 1 million. So it is 1 million divided by 2 times the strike. We know what the strike is. The strike is 15. We just said it now, 15. So 1 million divided by 2 times 15, that should be around 3333.33. But you know we are not done, because this amount will come in here. This is where it will come in. So you need to discount it back to this portion. So to discount it back, it will now be 1 plus the discount rate. Do I have the discount rate here? I can compute it. This is it. Annual discount rate, which is 1.50%. I have to prorate for how many periods? Prorate, this is 12 months. This is 5 months. So I'm prorating for 7/12, and I'm good. So whatever you compute should be your answer. Please, I don't know if there are any questions for me so far. Maybe in the chat, or there are any questions for me. Okay. I believe we are good. Please, if we are not good, you can let me know. I think we should stop here. So we'll stop here. We have 10 minutes more. I think we should stop here, because the next topic I could go to will extend more than 10 minutes. I think I will stop here. Thank you, everyone. But if we have access to the chat, and we can, let me know where we are struggling with. If it is something I can go through within 5 to 7 minutes before the next facilitator, please, what's the final answer? Okay. Yeah, let me show you the final answer. Just a minute. So the final answer is this. So that's it. So if you notice in the curriculum, look at how lengthy it looks like. So look at how lengthy the whole thing really looks like. So if you look at what's going on here, this is variance notional, but we have computed using logic. We've computed our variance notional. We computed our variance notional, which is vega notional divided by 2 times strike, and we have this. But this will come in at expiration, so we need to discount to today, which is a mark to market. So discounting back to today, we discounted for 7 months. So we did it directly, but in the curriculum, they used the formula. So this was their discounting. So what they did was this: after they've computed this variance notional, then times, they have their present value of t, that is counting this back to this portion A. So which I already did directly. So that's 1 plus the discount rate, then times 7/12 and so on. And please, you are prorating directly, please. Okay. Please, any other questions for me? Okay, I think I have 1 or 2 chats. So I have limited time too. So I would have wanted to, I had planned for all, but what I was told, it's more about exam techniques as against going through what's it called, the old curriculum. So I'm not sure it's a session for intense classes, just how to answer questions. I actually have presentation for currencies here also for questions, but unfortunately because of the limited time. Then I can also say a question here is 7 times 12, is it multiply or is not raised to power? Is 7/12. It's 7/12. If a question should ask to justify and its calculation, so if they should ask us to justify, so there are different ways of justification. So they could ask us to if they ask us to justify, let's discuss that. So let me see. Imagine they painted a scenario. Maybe I should use an example in currency management. So they painted a scenario and you were told that the investor is net short. So then they have here recommend whether or let me use common questions I've seen in different mock questions before, so I don't complicate. So investor, where should the investor hedge? Should the investor fully hedge, or should the investor tilt towards trading? So, and they told you that the investor is a short-term investor. So the investor is a short-term investor. So the first question that will come in would be recommend, should the investor, so the investor is short-term, the investor is more short-term, the investor, I'm trying to frame one other addition. So the investor is short-term, the investor's owners are skeptical of taking additional risk. So I think that should be okay. So now recommend where the investor should tilt towards. The investor should tilt towards fully hedging. That's your recommendation. Then justification should be, you justify by saying exactly what they requested for. So there are 2 ways of justifying. They could ask you on the exam day to justify why it is so. So why you chose the answer you chose. So you justify this by saying, I chose this because the investor is short tenure, and the investor's owners or shareholders are skeptical about taking additional risk, or they are risk averse. They could also ask us to justify why you did not choose the answer you chose. That means then you justify this. So please, while answering justification for this answer, don't answer justification for why you did not do it. So why you did it, justify it. Why you did not, they could ask that also separately. Why you did not. And for any calculation, just use logic. So it's strictly logic. If they tell you justify this, and naturally you expect it to come with calculations, what you should do if you expect it to come with calculations is this: just don't refer to the calculation. There's one currency question that has this, I guess is the first one. Don't refer to the calculation. You can say, oh, maybe return on domestic currency is greater than return on the foreign currency, but don't calculate. If they say justify without using calculation, then don't calculate, please. Let me check other. I think I have more charts. My child is struggling to navigate to the chat. Okay. Okay, so that's, I think I have more. Okay, so I'll start from the last, just to quickly, in 3 minutes. Can you take currency for 15 minutes before the next session? So I actually have a program at 10 that I have to join. But if I have a program at 10 I have to join, we just put the final answer. So you can put the final answer, it's completely fine. It's acceptable. But unfortunately, if you are wrong, the person will not get, you'll not get your answer. Differentiate between calendar spread and a bull spread. Okay, let me just quickly differentiate that before the next facilitator comes in. So I've explained a bull spread already. I'll just explain calendar spread. So when it comes to calendar spread, there are different types of calendar spread. We could have long calendar spread, and we could also have short calendar spread. And the way to recall is simple. For a long calendar spread, the volatility is in the long term. So in the short term, it's relatively stable. Then you have something like this. For a short calendar spread, the volatility is in the short term. So you have something like this, then it's relatively stable. And please, your strategy should be what? For it is where you have volatility that you want to buy. So in a long calendar spread, where the volatility is in the long term, what do you want to do? You want to go long option. You want to go long option in the long term. But in the short term, you would sell option. So because this is where it is flat. If you expect volatility is about stock prices moving around. Here, you want to go long option. That's in the short term now. In the near term, you want to go long option here, and you go short option in the long run. The other thing to notice, because it's calendar spread, the option you are selling should be the option you are buying. So the same here also. So if they tell you are going short call here in the short term, but you are going long option, let's say put, it cannot be calendar spread. So for it to be calendar spread, it must be the same option. I will stop here because I don't want to go outside. I know the next facilitator will be coming in at 10. The next facilitator will be coming in at 10. So I'll stop here. Thank you, everyone. Thank you, everyone. Bye for now.
Thank you so much, Olawale. Thank you. We appreciate it. Thank you so much. And thank you, everybody, for staying tuned. Our next facilitator is already in the room. His name is Chukwuka. It was Ezodenu CFA, and he'll be taking us portfolio management pathways. Chukwuka, over to you.
Okay, thank you so much. Good morning, everyone. Please confirm you can see my slides and can hear me very well.
Your screen is visible. Your voice is audible. Thank you.
Okay, thank you. Okay, yes, okay, thank you very much. So I'll start. So I'm just going to speaking about the portfolio management pathway. And so let me give a bit of a backstory. So I started, my level three was supposed to be written in 2024. And back then it was still combined. That means level three, you're writing everything. There was no pathway. You're writing portfolio management, you're writing private wealth, and you're also writing. Oh, I also appreciate Dr. Olawale Keshiro. I salute you. I don't know if you see on the call. So he was one of the people that really motivated me to go for this level, go for a CFA curriculum, CFA charter rather. And I'm happy to say that I was also I'll just probably DM him after this session. So yes, so it's back then there was no division or between pathways, so everything was single. And I remember having to study portfolio management, study a bit of private markets, and I also study private wealth. So it was a lot of information. But now the so I couldn't write in 2024. I eventually wrote in 2025. And seeing that they've now streamlined it just makes it so much more easier to follow and easier to understand. So before I continue, I want to thank CFA Society Nigeria for this opportunity and for helping level three candidates to just come together to really just rub minds and see how to get those winning strategies to make our exams a success. So I'll dive right in. So very, very few things to cover this morning. First of all is we are going to just review the pathway, not in depth, because I believe that everyone has already studied for the exam. Here we're just talking about final things to look out for while as we prepare to write the exam next month. So we just review the pathway and then some exam insights which I discovered during my own preparation and things that really, really helped me, and then some final words. So we have about an hour and 50 minutes to go. So I'll just take my time, and please, if there are any questions, where I'm really able to answer to the best of my knowledge. So the first thing is to review the pathway. So I mean I a bit it was a bit difficult for me to know exactly what to speak on, because even though it's a pathway and it's streamlined to just portfolio management, there are still so many things to consider, so many things to do. But what I'm just going to do, I'm going to stick to the most important things across the curriculum. So it's not necessarily reviewing the curriculum again, but just some things that's I think will just be good to rehash as we go on. So just a bit of a heads up. Initially, I tried to combine them into slides, but at some point it was looking too much. So I just had to extract my notes into a separate document, which I'm going to share. But for a few slides, I'll just share top things that really stand out across each of the LOSs. So the first is learning module two. So learning module one is very basic, so it's very straightforward. Then so I just decided to just keep that, and then for learning module two is active equity investing and then strategies. So if you know me on LinkedIn, my last post was about the fact that the CFA why I appreciate the CFA curriculum so much is that it answers questions that you don't even know you have. Some things that's I just assume, okay, this thing is just there. Or I see when research analysts make projections, come up with a target price for a particular security or a stock, and then they give recommendation buy, hold, or sell. We see that's a normal activity by research analysts, but that's actually what they call fundamental approach to equity investing. Fundamental approach means that it's discretionary, it's subjective, depends on analyst discretion and judgment. So an analyst basically just conducts research in a company or market or economy, and then based on that, they estimate the intrinsic value of securities. That's fundamental. On the other hand, it's quantitative approach. So I've not really seen any analyst that does quantitative approach yet. It seems like most analysts in Nigeria, I mean, people that I'm aware of, they always stick to fundamental approaches. When a company they attend earnings calls and then ask questions to the management, then use that to update their models. But I've not really seen quantitative approaches, which is where you use models to use models to rank, to select investment. So I did something like this a while ago. So while I was studying my level 3, I started to build something like that. So I just used spreadsheets. I ranked companies in the same sector based on their different ratios, including so price to earnings, price to book for banks, EV to EBITDA, and so on and so forth. Then the ones that have the highest, the most attractive variables, I said, okay, I'm going to invest in this one. So that's just using quantitative approaches. However, even though a manager or an investment manager says that, oh, my approach is quantitative, it doesn't stop them from using fundamental approaches when it comes to maybe picking their stocks. So they can actually use fundamental approaches, even though their own investment thesis is around quantitative investing. Also, a fundamental manager can also use quantitative approaches, maybe when it comes to ranking securities that are very good. So after you have done your research and you see that these 5 companies are very great, then a fundamental manager can use quantitative approaches to rank those 5 great companies, so to see which ones to invest in. But the difference is that quantitative investing is rules based, while fundamental is opinion driven. And then also there's also thematic investing where you have a theme, you have an idea that, okay, because let's say for example, Naira is not is Naira although Naira has performed well year to date, about 5% against the dollars, but because of the interest rate differential and inflation differential, which we learned in level 2, the fact is that Naira will continue to depreciate against USD over the long term. So if that's the case, then a thematic investor will say that, is there any Nigerian company that has significant activities abroad such that those currency movements, that is, though it might be unfavorable to Naira, but because that entity has operations abroad, then by the time it converts that currency, that USD figures into Naira, it's going to provide some kind of hedge. So that's thematic investing, just using themes, economic themes or expectations to drive your investment activities. The next is top down versus bottom up. Top down, you focus on the overall macro environment, broad market variables, and then you decide to overweight best markets that have economic potential, and then you underweight companies that are not so great. That's top down. Then bottom up, where you use company specific information to build portfolio. So, for example, there are 5. So we have an industry, let's say oil and gas, and then bottom up is you saying that let's say there's Seplat, there's Aradel, there is Connor, there's Owando, and so on and so forth. So bottom up is you now comparing those entities based on their specific individual characteristics. So you rank this one against this one and say which one is better among these 5. So that's you doing bottom up. But for top down, you think about it. Okay, let's say Nigeria's economy is still largely dependent on oil for crude oil inflows. Then you say, okay, let me invest in oil and gas companies, oil and gas stocks. So that's where you do fundamental. That's when you do top down approaches. Then there's also factor based. So a factor is basically a variable with which asset returns are correlated, and you can execute a factor based approach using a hedge portfolio, factor timing, and factor mimicking. Then there's also activist investing. So activists are people that want to transform a company from the inside. They buy the shares, then they try to make changes at the AGM or request for financial restructuring and so on. They focus on companies with slower earnings growth compared to the markets, negative price momentum, and weak corporate governance. Then in order how to defend against activists, so companies or management teams or even boards, they create maybe multi-class share structure, poison pill clauses, staggered board provisions in a way to combat the activities of these activist investors. And then there's one interesting that I read in research reports that's called um, pet trading, where you see 2 companies in the same industry, or so for some reason one is trading at a very high multiple compared to the other one, and both they are decent companies, we are well-run organizations. So it means that there are some pricing inefficiencies in the market sometimes that an active investor might decide to just take advantage of. So it's called statistical arbitrage. So you just monitor the price activity between these 2 stocks for a long period of time, and then if that pricing gap still exists and you believe that there'll be mean reversion in the future, then you can maybe short the one that is highly valued, and then you buy the one that is a bit undervalued. Then hopefully there'll be there'll be what's the word now? There'll be a integration of the prices in the future. So you buy, so when you make your trade, then you watch to make sure that there's a mean reversion. The one that is highly valued will come down, and the one that is undervalued will come up. So by the time that happens, you just close the trade. So that's what they call statistical arbitrage. Then there's also market microstructure, where you look at order book and you try to take advantage of small changes in prices that happen in very, very short period of time. Then there's also event-driven strategies, which is driven by corporate actions. For example, when they announce that, when maybe a company announced that I'm going to acquire, I mean, the shareholders of this company have agreed to my acquisition bid. What an active manager can short the shares of the acquirer and buy the shares of the targets, because to be expected that as that's before they're able to buy out the minority shareholders, the price will increase. So that's just event-driven strategies. And then there's some pitfalls in fundamental investing, such as behavioral biases, value trap, growth trap. So value trap is when a stock appears to be attractive because the price has really dropped and multiples are quite low. But the truth is that the market is already realizing that this company is actually not as good as it is. And the trap is that you might buy it thinking that it's going to recover, but it actually just keeps declining. So that's a value trap. On the other hand, a a trap a trap that comes, or a pitfall in fundamental investing, is called the growth trap. This is where a stock is already reflecting so a stock appears to be attractive because of its high growth prospects. For example, the stock is trading at a PE of 17 times when the average of its peers is around 5. And then you look at it and say, oh, this company actually has strong growth potential. And then you buy. Meanwhile, all of those growth potentials are already being reflected in the price and the multiples. And then so the chances that when you now buy it now stagnates. And then you're wondering what's happening. The potentials have actually been already priced in to the price, into the stock price and into the multiples. So those are pitfalls, because fundamental investing deals with opinions, deals with judgments. So these things can happen because it's not driven by pure data. It's data plus interpretation. On the other hand, quantitative investing also has its own pitfalls. Things like survivorship bias, look ahead bias, data mining, transaction costs, and inability to short, especially this inability to short, because a lot of the strategies that are linked to quantitative investing has to do with two stocks. So you're buying one, you're shorting one. So if you're unable to short, like in Nigeria, we can't short. I don't know why we still can't short in Nigeria, because there's so many opportunities that I would have taken advantage of, but I can't short and I can't borrow. Anyway, so if the ability to short is just going to really impact the ability to fully express your views on express the views that your model is telling you to do. And then further down in the learning module, we have star classifications. We have holdings based returns. We have returns based star classification, and we have manager self identification. Holdings based is basically looking at each stock in a portfolio. Is it value, or is it growth, or is it a mixture of both? So for each of the stocks in a portfolio, for example, I personally, in my portfolio, I have about, so out of like 12 stocks, 7 of them are value, 3 of them are growth, and then 2 are a bit of a mix of both. So if I'm now going to characterize my entire portfolio, I'll say my portfolio is value tilted because most of the stocks there are value stocks. So that's holdings based. For returns based, you take the portfolio as a whole, and then you regress the returns against the return of maybe a value index, or a growth index, or a blend index. So the one that has the highest correlation is what that's what you're going to attach to your portfolio. For example, in Nigeria, we don't really have a Nigeria. We need to improve. We don't have a value portfolio before, unlike S&P 500, for example. There's S&P value index, or S&P value ETF, where the components or the constituents of those indexes is just value stocks. So if I regress the returns of my portfolio against that index, and if it gives me a correlation of 0.9 of 0.9, I do the same for a growth, it gives me about 0.75, for blend about 0.3, then it's obviously clear that my portfolio is a value portfolio. Is a value portfolio. And then the other way of classifying style of a portfolio is manager self-identification. So sometimes managers just tell you that, oh, I'm a I'm a value manager, I only touch value stocks. One can say I'm a growth manager, I only touch growth stocks. And then finally, before we go to the next segment, is portfolio construction. This is LM3 rather, portfolio construction, and it's also about active equity investing. So the concept behind active equity investing or active management is that a manager believes that he can identify and differentiate between the most attractive stock and the least attractive stock compared to the benchmark. Because the benchmark contains the entire ecosystem of stocks, like the NGX, for example, contains about 126 stocks, but some of them have delivered returns of more than 300% year to date, and some are down by, let's say, 15%. So it encompasses the entire market. But an active manager would say that I know the difference between a high performing stock and a least performing stock. And then I want to take advantage of that knowledge I have to create a portfolio. So that's active investing. So once the portfolio manager is deviating from tracking the index based on the weight of each stock, then is entering into the realm of active investing. Active return is the excess return compared to the benchmark. So when you compare the return of your active portfolio, when you compare it to the return of a benchmark, if there's a positive return or a negative return, that is the active return. And then so you multiply the difference in the weight by the return of that portfolio. And that's formula there. And then so sources of active return, there are three main sources. First of all is the level of exposures to rewarded factors. Number two is tactical exposure to mispriced securities and rewarded risks. And then number three is the unexplainable factors, which is just classified as idiosyncratic risks. So active returns. So
Chukuka, we've lost your connection. We cannot hear you if you're speaking. Please kindly log out and rejoin the meeting. We can see that you're unmuted, but we can't hear you. I think your network. You've lost your connection. Thank you.
apologies, my network threw me out. Let me just continue. So sorry. Okay. Can I continue?
Yes, please go ahead. We can hear you loud and clear now. Thank you.
Okay, apologies. Thank you. Okay, yeah. So I was talking about the source of active returns, and I said that the first one is level of long-term exposures to rewarded factors, and I'll be explaining that rewarded factors are the variables that have been proven to explain returns over a long period of time. So, for example, there's size, there's value, there is markets, there is momentum. There are many, but the major five are the ones that were founded by Farmer and French. Then the rest are some factors are unrewarded because they have not been able to consistently explain returns. And then I was saying that that's the one of the most important building block. They're all important. Factor weightings, alpha skills, and position sizing. They're all important, but position sizing is what really can really drive the returns, because if you believe that a stock or a company or a security is undervalued and should be experiencing some rating in the future, then you should show that conviction by investing a lot of money or allocating a lot of your portfolio resources to that sector. For example, I have a personal experience. So there was a stock I saw, like, oh, the stock is nice, let me buy it. And then eventually I did. But by the time I checked again, that done about 300 and something percent. But what I had inside of that stock is just a few very tiny amounts. I was just saying, why didn't I just put a lot more cash into this thing? If I was very sure, I was sure, but I don't know why they just didn't take advantage of that this thing. So a very important part of this is position sizing. And then there's also breadth of expertise. Breadth of expertise is what integrates all of these different building blocks. If the manager is very sure about what about the factor weightings, very sure about the alpha skills and position size, and then that breadth just really brings everything up together. And then they have to calculate expected return is the transfer coefficient times information coefficient times square root of breadth, and then times the active risk. Then also a very important concept which I found very interesting during my study back then is active share. So active share measures how different a portfolio's holdings is from a benchmark. So if active share is equal to 0, then it means that the portfolio matches the benchmark in terms of constituents. But if active share is 100%, then it means that the portfolio has no linkage. So for example, so it was a bit tough for me to really understand how to interpret this thing. But what I just did was that, so I imagine that there's a chart. Oh, let me see. I think I should be able to draw on this thing. Okay, let me see. One moment, let me just include the chart here. So I'm assuming that let's make sure my screen is being seen. Yeah. So assuming that this at 0 here, this is the portfolio itself. And this is the benchmark. So if active share of a portfolio is equal to 0, that means that it is completely the same as the benchmark. But as it moves away towards the right, as it increases from 0 to 1, it is different, or it is having different components or different constituents from the benchmark. So the higher the active share, the lower the higher the active share, the less the portfolio looks like the benchmark. So that's the way that just made me understand it, and since then I never had any struggle with it. So active share is the difference between the weight of a stock on the portfolio, the constituent of a portfolio compared to the constituent of the benchmark. If it's 0, it means that the portfolio and the benchmark are exactly like the same, but as it increases, the portfolio is looking less and less like the benchmark until it gets to 1. And then when it gets to 1, it means that it is completely different from the benchmark. So back to, and then the formula is there. So this formula is very important because so it took a while for me to really understand it. The formula is half of the sum of the active weight. An active weight is the weight of the portfolio minus the weight of the benchmark. And notice there is the absolute sign, meaning that it's always going to be a positive answer. So the answer will always be between 0 and 1. Then active risk is the extra volatility that arises from creating an active portfolio. An active portfolio is if you have constituents that differs from the benchmark in terms of weighting. So a manager can increase control over active share very easy by reducing the differences between the portfolio and the benchmark. So an active manager by definition should actually have active share, because if your active share is 0, that means you are exactly tracking the benchmark. Then there's no reason for investors to pay you active management fees beyond what they pay a passive manager to to manage their portfolio by tracking the benchmark. So a manager can increase. Managers can have a high active share, but the active return just has to be higher to justify the extra risk that comes from from holding securities that are different from the portfolio. So briefly, just quickly go to the next document to present here. And then if there are any questions, can just put them in chat box. There'll be sufficient time for questions. And so, yeah. Yeah. One moment. Okay. Sharing my screen again. Please confirm you can see my notes. It's a bit tiny, but I'll just quickly just read through something that I just want to make mention of. Can you see my screen? Okay, thank you. I'm so sorry. Ete wants to turn back to my village, but they will not succeed. Anyway, please confirm you can see my screen. Okay, I can see a question. Okay. Okay, thank you. So I can see a question. Muhyiddin is asking, in terms of risk, can you briefly differentiate between active share and active risk? Yes, active share is the difference, is calculated, and it's different between the portfolio, the portfolios, the weight of a security in the portfolio compared to the weight of a security in the benchmark. So the formula is half. Let me just put the formula again so everyone can see. So this is active share. Active share is half of the sum of the difference of the portfolio of a security in the portfolio minus the weight of that security in the benchmark. So active share is just different. If you are holding, let's say it's in a portfolio of 3 stocks, MTN, Airtel, and RDL, for example, and in the benchmark they are equally weighted, 33.33% across the board. But in your own portfolio, you have RDL at 50%, you have MTN at 20%, and you have Airtel at 65%, because you are holding those securities at a different weight compared to the benchmark. Then there'll be active share. And how you calculate the active share, you do it for each of the securities. So, for example, weight of RDL in my portfolio minus the weight of RDL in the benchmark plus weight of MTN in my portfolio minus the weight of MTN in the benchmark plus weight of Airtel in the portfolio minus weight of Airtel in benchmark. You sum everything, then you divide it by 2. That's how you get the active share. On the other hand, active risk is the volatility that comes from having an active portfolio. Like I think I should just show you the formula of that as well. So that's the difference. So active share is not really, it's not really a measure of risk as in the sense of risk. It just shows how much is your portfolio different the from the benchmark, and that will help us to understand if you are going to outperform the benchmark. Is it because you are weighting your portfolio differently than the benchmark or something else? And for active risk, this is the formula for active risk. Yeah, let me just quickly paste that here so you can see. So this formula for active risk, it is a standard deviation square into times the beta of your portfolio minus beta of your benchmark times the factor weight plus and a standard error term. So that's the formula for it. So it's always also based on the beta of the portfolio minus the beta of the benchmark, then times the factor weighting plus the error term, then square roots. So that's how I calculate active risk. So active risk is quite different from active share. So I hope that helps. So quickly, I'll just move on to the next thing next on the page. Okay. Yeah, so active risk is a consequence of active share and factor bets. Because if you don't have create an active portfolio, then the risk of your portfolio will be the same as the risk of a benchmark. But once you start deviating from a portfolio, from a benchmark to create a new portfolio, then active risk will come in. The next thing is risk budgeting. So when it comes to calculating your portfolio variance, it is the sum of each asset's contribution to total variance, as you can see on this screen. So the formula is weight of security I times weight of security B, then times the covariance. So in the question, we'll look at questions soon, and they'll give us the weighting of each security. So just multiply that weighting times the weight of the other security times the covariance between security A and security B. So in this case, the covariance of security, the weight of security A is 0.2, weight of security B is 0.3. So, and weight of security C is 0.5. So how to calculate the total portfolio variance? In a question, they'll ask you that what is the contribution of A to the total variance? What you need to do is first of all calculate the total variance and then calculate the correlation of the contribution of asset A to overall variance. In this case, the weight of A is 0.2, weight of B is 0.3, weight of C is 0.5. So you calculate by saying weight of A times correlation covariance of A on A plus weight of A times weight of B times correlation covariance of A and B plus weight of A times weight of C times covariance of A and C. So you get a total portfolio variance. And then already they also give you each of the individual covariances of each of the assets. So just say the covariance of A divided by the overall portfolio variance, you get 34%. So that's how you calculate it. You can also give it for sectors. It will say the overall market variance is 0.00 something. And you say you calculate the contribution of energy sector to the overall market covariance. You apply the same formula: weight of sector A times weight of sector B times the covariance of A and B. So that's how you compute that particular one. Then yeah, so also the same thing. Usually in the exam, they will not they mostly so my experience, they will hardly give you questions that will require long calculations. Sometimes they'll give you the what's it called, maybe some of the metrics or the variables. If they'll tell you to calculate one and they'll give you another one, or in some other cases they can ask you to calculate both of them. But because it's timed, you just need to calculate maybe one of it, maybe covariance of A or covariance of B, and then you just do the calculation over the entire portfolio to get the contribution of that particular asset to overall and portfolio variance. So just quickly moving on. So this is an example where we said that they can ask you to calculate the proportion of a particular factor's variance to the overall market, to the overall portfolio. So in this case, they asked us in the example in one of the boxes that you calculate calculate. So they give us the variance of the entire portfolio. So in that question, the variance of the portfolio was 3.07%. And they asked us to calculate what is the contribution of the market factor to overall variance. So all you just need to do is to use that same formula. So for markets, when it comes to markets, because you can't really weight factors the way you weight securities. For securities, they'll give you the weight of each security. And then please, in the exam, please be very careful. If they're asking you to calculate for factors or the contribution of
We apologize for the inconvenience. His network has actually thrown him out totally now. He's trying to rejoin as soon as possible.
apologies once again. I've changed my network now. I'm no longer using Network. I'm very sorry. So let me just continue from where I stopped. Please, where did you hear the last thing I said? Okay. I'll just continue from immunization. I think that's where I stopped. It is well. Anyway, so yes, I was explaining that immunization is a way to sterilize your portfolio or if your liability. If you have a liability, for example, if you are supposed to pay maybe a child's school fees in about 5 years, and let's say is 100 million naira, it's fixed 5 years time. In because you don't want to keep bothering about keeping saving cash every every year or something. If you have enough money, you can just decide to buy a zero coupon bond that will mature on the maybe the month before that school fees is due. But in Nigeria, there's no zero coupon bond, so you cannot really use that as a way to immunize that liability. So what can be done instead is to just buy a portfolio of bonds that will be structured in a way that it matches the characteristics of that particular liability, such that any change in the value of liability will reflect in the value of portfolio that you have. So it's usually used by pension funds who have defined benefit obligations. And back in level two, we learned how to estimate those liability. You consider interest rates, consider tenure of the average tenure of your staff, staff useful staff years to maturity, years to retirement. So those variables are used to estimate the liability. It's also being used by also going to be used in creating that bond portfolio. So immunization just means that you're making sure that any change in the value of that portfolio is also what is happening in liability, so that eventually the net impact is very, very little. So in summary, the characteristics of a bond portfolio structured to immunize a single liability is that number one, it has an initial market value that is greater than or equal to the present value of liability. Number two, it has a portfolio Macaulay duration that matches the liability due date. And number three, it minimizes the portfolio convexity statistic. They're going to ask you, they might ask you some of these things. Know how the questions are. I'm sure you've taken mocks and you see how it is. Maybe two people will be discussing, they'll be chatting in the office, and then they will say, "Oh, what are the characteristics of a bond portfolio structured to immunize a single liability?" Person will mention three things, and they'll ask to see which one is correct, which one is incorrect. So number one, that portfolio has to have an initial market value that is greater than or equal to the present value of liability. Number two, that bond portfolio should have a portfolio Macaulay duration that matches liability due dates. And number three, that portfolio should minimize the that bond portfolio should minimize the overall statistic. In fact, there are so many questions like this. They'll give you three bond portfolios. I think we're going to see questions around it. They'll give you three different portfolios. Say, okay, which one? Which one should we choose? You'll see that they're similar. They're always similar in different ways, but one will have the lower convexity, because convexity is like the measure of dispersion of returns of a bond portfolio. You don't want the portfolios to be so dispersed. You don't want the convexity to be so much because you are managing a single liability. So if they give you three options and they are all the same, the market value exceeds the PV of liability, the market duration is around the same time, or the match liability due dates, just look out for the convexity. The one that has the lowest convexity for single liability, that's the portfolio you choose. So moving on, so they said, so this one is strategies for a single liability for multiple liabilities, including alternative means of implementation. So there's duration matching. So when you have a single liability, what you can use, the approach to immunize that single liability is duration matching, meaning that you just compare the duration, money duration of the portfolio should just match the basis point value of that debt liability. If you have a single liability, then you need to just make sure that the basis point value of the portfolio matches the basis point value of the of the liability that you are trying to immunize. Then for multiple liabilities, it's also the same thing. But in this case, for multiple liability, the duration, the basis point value of the portfolio should be greater than or equal to the basis point value of the liability. Yeah, so that's that. So then some questions and some examples around that. That's when it comes to using duration matching to immunize a portfolio. You can also use overlays. the derivative overlays. An overlay is just a set of synthetic methods to transform the aspect of a portfolio. For example, you can use FX derivatives to change the currency feature of a portfolio. So that's a way to use derivatives. I'm so sorry. At this point, I have to get Starlink because even MTN is messing up. Sorry, apologize. Just quickly continue from where I stopped. Oh, okay, so that's continuous immunization. So back to so for examples, I want us to look at examples. So okay, we'll look at examples soon. Okay, just quickly rush through this. Okay. Yeah, so I want to just quickly make sure that I've covered the most important things. So that ones can just quickly read up on them to get the gist. Okay, yes, just some notes that I just want to quickly rehash before I move to the next thing. So structural risk is reduced by minimizing dispersion of bond positions, going from a barbell to bullet. So remember we said that when they give you 2 or 3 portfolios, I want to use to immunize a single liability, and they have the same Macaulay duration, and then they have the basis point, the market value is higher than the present value of liability. Please choose the one that has the lowest convexity, because that's one that has the lowest structural risk. So compared with other weighting methods such as equally weighted, value weighted indexes are tilted towards to securities with higher levels of debt. Yeah, this is just basic stuff. So also, even if in the case of single liability, okay, let me just start from here. So a cash flow matching strategy will mitigate the risk from non-parallel shift in the yield curve. Non-parallel shift and twist in yield curve can change the cash flow yield on the investment portfolio. However, minimizing the dispersion of cash flows on the portfolio will mitigate that risk. I remember in the case of a single liability, immunization is achieved by matching the bond's portfolio Macaulay duration with the horizon date or the maturity date of that liability. That's for single liability. And then if it is multiple liabilities, then you need to match the basis point value. Then even if money duration is the same for asset and liabilities, a non-parallel shift may cause assets to overperform if the assets have lower convexity and dispersion than the liabilities. So the liabilities will change by greater amount than the assets. For a single liability, aim to match or exceed the money value, the monetary value, market value, Macaulay duration, and lowest convexity. But for multiple liabilities, your aim should be to match or exceed money duration and convexity. So I'm almost done with the review of my notes. And then, so the next part is yield curve strategies. Trying to rush because of time. So yield curve strategies. So I really like this yield curve strategies because before now, when I was preparing for the exam, so I know about the yield curve, from level 1, level 2, but it was still a bit vague. But reading through this particular learning module was really helpful. So there are 4 things that drive fixed income returns. The first one is the coupon income, followed by the roll down return plus or minus expected change in price due to view of benchmark yields, then expected change in price due to view of yield spreads, and then also change in price due to currency value changes. And so I'll just quickly go to then yield curve slope is defined as difference in basis points between the long-term yield to maturity and the yield to maturity on a shorter maturity bond. So as the spread widens, the yield curve steepens, while a narrowing is a fraction of the yield curve. Then how to compute the curvature or how to estimate the curvature of the yield curve is the butterfly spread, and that is calculated by minus the short-term yield plus 2 times the medium-term yield minus the long-term yield. So butterfly spread becomes more positive when the yield curve has more curvature. So when you have a negative butterfly spread, it means that the yield curve is humped because the middle side is higher than both the long and the short. When you have a negative butterfly spread, it's convex because the middle side is less than both the short and the long. So because you have that 2 times at the middle, so it really gives it more impact on calculating butterfly spread. Then, so calculating portfolio duration and convexity. So active managers position their portfolios to capitalize on expected change in the level, slope, and curvature of the yield curve. So how to calculate the change in price of a portfolio or change in value of a portfolio is minus modified duration times change in yield plus half times convexity times yield square. All these formulas are in the curriculum. So I'll just move past these. Then, so to yield curve strategy proper. If a portfolio manager expects a static yield curve, doesn't believe that, so you believe that yield curves, the bonds are currently fairly priced and does not foresee any sharp upward or downward shift in yield curve, then it can execute a static yield curve strategy. So the first is to buy and hold. Just buy the bond and hold it to maturity. You earn income due to coupons. Even if your investment horizon is 3 years and you don't plan to hold above 3 years. If you expect a static yield curve, you can actually buy buy a 5-year bond or a 10-year bond and just hold it for 3 years and then you sell. Because if your expectation materializes, you're just going to earn roll down return. So that's roll down return. So if the yield curve is upward sloping, just buy bonds that have slightly longer maturity, and then you buy at a lower price, and then you get more coupon compared to what you have gotten if you buy it. Because longer term bonds tend to have higher coupons than shorter term bonds. So that's an opportunity to earn extra income if you're expecting a static yield curve. And there's also a repo trade which can be used to participate in the market if a static yield curve is expected. Then using bond futures. So you can use bond futures to execute a static yield curve strategy. You don't have to be buying the bonds, especially if it's an institutional investor that does not have free way to trade the bonds. Can just use bond futures. And how to calculate the money duration of a bond future is the basic point value of the cheapest to deliver bond divided by the conversion factor of the cheapest to deliver bond. So that's one. And then there's also the dynamic yield curve strategy. If you believe that the yield curve is going to change, then you want to participate in that. So there are 3 ways you can do it. If you believe that, so you can either buy the bond, cash bond purchase, or take a receive fixed swap or long position. This is a way to increase duration. So you want to increase duration if you think that there's going to be a parallel shift in the yield curve, can increase duration. And to increase duration, you can buy a bond or enter into a receive fixed swap or into a long forward duration, long futures position rather. But if you believe that the yield curve is going to be more volatile, if you're expecting maybe a strong economic growth or rebound to increase yield, then you might want to reduce the impact of higher rates, because when yields are higher, it depresses the value of a portfolio. So you want to reduce duration. On the other hand, you're expecting that there might be like a contraction in the yield curve. Then you want to increase duration to take advantage of that, because when there's contraction in the yields, that means prices are rising. But if you're expecting the yields to rise, then you want to reduce duration so that the impact will not be so great. You can either sell a bond or enter into a pay fixed interest rate swap to receive floating, or you enter into a short futures position. Now, for example, I have an example from the curriculum. So a manager enters into a 50 million notional 5-year pay fixed swap with a modified duration of 4.32. So how to calculate the modified duration of the portfolio's modified duration be calculated as, so the formula was is up here. So when it comes to calculating the basis point value, modified duration times the notional times 1 basis point. So that's what we're going to use to just calculate the overall portfolio modified duration given these parameters. Yeah, then so also if you're expecting that the yield curve slope is going to increase or decrease, you can position for that. I have a small example here from the curriculum. So for example, the short 2 year um 2 year bond, the coupon is 0.25%. The portfolio, the size of the coupon of the bond in portfolio is 163 million. Modified duration is 1.994, and the convexity is 5. Then if you in this case, the person wants to participate in a yield curve steepener because he expects that the long end of the curve is going to rise. So when it rises, you want to be short that, so you benefit from that steepening. So in this case, you buy the short end and you short long end. So calculate the notional, the overall principal, the overall portfolio value will be 163.8 million of the long minus 36.2 of the short. Then so calculate portfolio duration to be the long, that's 1.994, times the value of the long divided by the value of the overall portfolio plus the modified duration of the short, that's 9.023, times the value, which is minus 36.2 million, divided by overall, then you get 0. So the duration is going to be 0 because what you have done is you've hedged your position by taking a long and a short. So it's not even just the position. It's not the fact that you are duration matching. You are neutralizing the portfolio against any activity, against any parallel movements. So zero duration is what you want to achieve if you're just trying to play a yield curve steepening or flattening move. Then that means that if the duration is 0, that means what the manager is expecting is to benefit from convexity. So in this case, our convexity will now be 5 times the weight of the short long compared to the short and compared to our portfolio, plus the convexity of the short 10-year times minus 6.2 divided by the overall portfolio size. So that means that the convexity of the portfolio is negative, such that by the time that expectation materializes and then the yield curve steeping and the long end rises, then the gain will be 127.6 million times 0.025 squared. Remember the formula, times the overall convexity of the portfolio times 0.5. So it give you a loss of minus 7.712 of 7 of dollars. So, but assuming that the short term yield maturity now declines by 25 basis points and the 10-year rises by 25 basis points, the impact is going to be different because he has been able to position the portfolio to take advantage of a decline in a parallel shift in the yield curve. So the same formula minus 1.994 times the change in the yield plus the portfolio convexity of the long of the 2-year times half times 0.025% square, 0.025 square, give us this value. Then by the time you do all the calculations, you get the gain that's going to experience, going to recover from the trade. So it is more like you using based on your view of what the yield curve is going to be, now determining what trade to make, right? Which side should I buy, which side should I short. So there are so many other strategies. There's a bear steepener, there's a bull steepener. So a bull steepening occurs when short-term yields fall by more than long-term yields. And then on the other hand, a bear steepening occurs when apologize again. Sorry about the network issues. Share my screen again. And please, if there are questions, please ask on the chat box. That's just respond to them as we go along. So yes. So now on to moving on to credit strategies. So active management credit strategies. So the same way we have drivers of return for fixed income securities, where we said is driven by coupon income plus roll down return plus changes in benchmark yield and spread and currency value changes. Yeah. So now I want to look at the changes, the portion of that fixed income return that comes from changes in credit spreads. So credit spreads. So the main gist here is that there's high yield credit and there's investment grade. High yield always has higher returns compared to investment grade, and that's why they are more riskier. So all these floating rates, I'm not going to talk about those ones. Then, so changes, the same way we can calculate the change in the portfolio value due to a change in yields. We can also do the same thing for a portfolio of credits. So we can calculate the change in the present value or change in value of the spread. The spread duration can be calculated by seeing effective spread duration times the change in spread plus half of the effective spread convexity times change in spread square. And then a very important metric is this excess spread, which is calculated as the initial spread minus the effective spread duration times change in spread. And then the excess spread return is the initial spread minus effective spread duration times change in spread, then minus probability of default times loss given default. I'm sure that everybody already knows all these formulas, so I'm just going to really move through it. This is the part I want to really touch on. I want to spend time on reviewing, walking through a mock together, just a few more questions. So how to calculate that? Yeah, so the next topic is this implementation shortfall. Yeah. And so also I want to just mention about the CDS price. So how to know calculate the CDS price is minus change in the credit spread times the effective spread duration. So it's good to know if you are doing if they ask you to calculate the changes in the spread, that'll be due to maybe changing the price of the CDS due to changing spread. So you calculate the difference in the spread in basis points times the effective spread duration. So that's what to give you that's how you see the change in spread, and I can now use it to calculate CDS price at initiation or subsequent price of the CDS. Then yes, so let me just walk through this example. So the same way for bonds, we have static yield curve strategies where you just either you buy and hold or you roll down the yield curve. For if you're expecting a static I'm so sorry. At this point, I don't know what to do again. I just hope this network doesn't fall off anymore. I apologize, Nigeria. Anyway, so yeah, so about trade strategy and um yeah, I'm sure well, this is very straightforward actually. Just calculating implementation shortfall, knowing when to yeah. So I remember so sometimes in this kind of question they can ask that they can give you different different trading objectives, and then they'll ask you which some of the more questions I've seen. They'll ask you which of them, which based on the objective, where should this trade be executed. Sometimes they can tell you. So these are things you can use to you should use to determine what trading strategy you should use. Other characteristic: side, are you buying or selling? Is it large? And then what is the relative size of that trade compared to the average daily volume of that particular security? If prices are rising, then if you execute a sell order, you can just do it quickly compared to a buy order. And then also to determine the trading strategy, consider the security characteristics. Is it price volatile? Is it liquid? To identify the means of the best way of best venue to trade that stock is also going to be required to know which strategy to use. And then also market conditions, trading cost aversion, market impact, and so on and so forth. So, so quickly, I'm just going to go to the slide, back to the slides. And then, yeah, so before I go, so it's also important to know how to calculate this implementation shortfall. So paper return minus actual return, then paper return is the price that you have executed at the actual price you executed minus decision price times the quantity sold. And actual return is a bit more elaborate. The quantity sold times the current price minus the transaction price of the shares. So it's very interesting how to calculate this. And also expanded implementation shortfall, where you can include delay costs, trading costs, and other things like that. Just trying to make sure I think, and then also there's some of these other formulas to calculate arrival price side times the decision price minus initial price divided by 10 divided by the initial price times 10 raised to power 4. So all of them are always going to be in basis points. VWAP also, time weighted average price, market on close, and so on and so forth. This calculation I just need to just rehash those calculations, trade governance, blah 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 blah, things like that. Now let me just go back to my slides, but I have more important things to discuss there. So we have done other topics. Now for exam insights. So one thing I found very useful back last year was understanding the command words. Please confirm you can see my screen. Please, can you see my slides? Okay, thank you. So the command words is is very important. I heard Dr. Wale saying that if they ask you to justify, just justify. That thing is so true. If they say analyze, take apart something in the exam. I mean, based on the mocks I've seen, nah, some command words are more frequent than the others, but it's good to know what they are all asking for. Analyze means take something apart for study. Calculate means should I can calculate it, can find a correct numerical value. Compare. This is very important. When they say you compare two strategies, it means you explain how two or more things are similar and how they differ. Then contrast is when you just separates, just state the difference between both of them. But compare, provide similarities and provide differences. Define means you show the exact meaning of a market or technical term. Demonstrates. So for demonstrate, they'll tell you demonstrate by defining or demonstrate by contrasting. So demonstrate always comes with another command word. Describe, determine, discuss, estimate, evaluate, explain, formulate, identify, interpret, justify. To justify and recommend are very like, a bit more popular than the other ones. Justify will tell you they're asking, okay, defend it. Like tell us why it's a good reason. Tell us why it's appropriate for this particular scenario, things like that. Recommend is also one of the more popular command words. So if you would like to just take another look at these command words, so I like the fact that CFA they publish this command word list of command words and get them through the link below. So they just read them to make sure you understand the examples. So they'll give you the command words, the meaning, and then the examples. So it's use cases so that you know exactly when to use those command words. And then right now, a few days to the exam hall, I'm to the exam. For what is very important is to go through those blue boxes. So I remember very early when I was initially why so people ask oh that should I use a prep provider or should I not? I said, I mean, if you can afford a prep provider, please go ahead. But for me, because I saw this thing in the curriculum very early, the fact that this last paragraph that says that the curriculum, including the practice questions, is the basis for all exam questions. The curriculum is selected and developed specifically to provide candidates with the knowledge, skills, and abilities reflected in the CBOK. So everything you actually need is in this curriculum. Even though you have just like maybe 5 or 6 days to the exam, yes, you can still extract value from blue boxes because all of the questions you're going to see will come from that curriculum, will come from the blue boxes. So I'm referring by the blue box, I'm referring to these questions, the examples that you see in the curriculum. So so back then I used my notes which I just projected and the blue boxes. At this point, I don't even recommend you going to read the curriculum again. There's no time for that. So what I think you should be doing is to just read through your notes, summarize notes if you have one, and then just review the blue boxes again, especially for topics that you just want extra confidence in. Because the questions will come out from the blue boxes. It's clearly stated in the curriculum. And then also, if you have some more time, you can just maybe walk some examples again. If you can't remember some of the things, just to review those examples, resolve them on your notes. But if you can't resolve them, just walk through it in your mind, looking at it from as looking at the answers as you walk along. Then what about constructed responses? Because level 3 essay and MCQs. So the solution is to just keep it short and simple. So I attended classes for my level 3, and then one of my tutors back then was saying that if they ask you if they ask you a question, just keep the answer as short as possible. We refuse. We says a lie that is this can they okay, Howard's hand is up. Okay, she can please Howard speak. Wow. Oh wow. So I'm so sorry. I thought I was sharing my slides. Oh wow. Okay, I'll just go back. Apologies. Okay. So these are the command words that I was talking about. So these are command words that in every question they'll give you a word that will determine how you answer. So those command words are very important. I remember I took like a few hours to just read through them to make sure I understand exactly what they're asking. Because if they ask you with contrast and you're comparing, you might not get the full score. So just stick to the exact thing they're asking you. And those are the command words that you should use. There are about 17 in all. So just reviewing them to know how to answer the questions. And then I put a link here. I created a shortened link so you can just use this to access the PDF that contains the words, the explanations, and then the examples. So those are the command words. And then yeah, blue boxes are very important. CFA curriculum they stated clearly that the questions in the exam are the basis for the blue boxes, the examples, everything are the basis for the questions you see in the exam. And it's so true. Like so before I used to be like, it's a lie, I just boboing us. But level 3, I saw it that it's actually true. All the questions are so it's not to just copy and paste the questions from the curriculum. No. But if you've walked through blue boxes specifically, you see the questions that you'll see like it'll be very similar. Like, it won't be strange to you because you've gone through them before. So I've also taken the liberty to extract all the blue boxes in the pathway, so I can share them with the society with collab. Maybe she can also share with you guys. I'm not sure. I don't know how that will work, but blue boxes are the next most important thing right now. Blue boxes. Then just you reviewing your notes selectively. And I don't at this point. I'm not recommending. I don't advise anybody to open the curriculum because there's no more time for that. But just stick to the blue boxes and also your notes, so you can be able to retain some of those things that you've learned. You started reading from a while, And then also, so, okay, I can see a question. In simple terms, please briefly explain the bull flattening, bear flattening, bull steepening, bear steepening in terms of execution strategy. Okay, bull flattening. I wish I can draw. I don't have a pen to draw. Okay, let me try. Let me try to draw. Let me share my screen so I draw. One moment, please. Okay. Let me please share my screen. Yeah. Okay. Let's take this as a let's draw. Okay, my PowerPoint is the old one. I can't draw. Wow. What do I do now? Okay, I'll try to use just basic lines to draw. Let's say this is your this is your yield curve. So this is your yield curve. This is the graph, and then no, it's not working. Sorry, let me just use a straight line to depict the normal yield curve. So this normal yield curve, for example, upward sloping. Now, if you're expecting a bear, let me start with the good one, bull flattening. Bull flattening means that the long end of the curve is dropping by more than the short end. This is bull flattening. Bull flattening. So why is bull? Is because yields are dropping, means that prices are rising, and then flattening because it is less steep than it was before. So if you're expecting a bull flattening, what you can do, you can long this end, and then also you can also buy both ends, because as the yield drops, you are when you by the time when the yield is dropping, you are okay. Yes, actually, so because you're expecting the yield you're expecting this thing to drop, you can buy, because when the yield curve is when it's dropping, the basis points will be negative, and because you already have a negative symbol in the formula, then when negative multiplied by negative, you are going to be gaining. Yes, that's it. Then on the other hand, bull steepening. So let me just replicate this so I'm not doing the same. So bull steepening. So bull steepening means that the okay. Oh, let me talk about bear flattening first. So I'll just take them side by side. So for bear flattening, so this is initial yield curve. Then if the long short end rises by more than the short end, then it's bear flattening because the yield curve it's bear because the short end, both sides are rising, and when the yields are rising, then it means that then it's not good for an investor who is long. So you should be short both sides if you're expecting a bear flattening, because higher yields depresses price will depress prices. That's bear flattening. Then the next one is bear steepening. Hold on 1 sec. Okay, so for bear steepening, what we're expecting. So for bear steepening, the yields are rising, and then so let's say this was initial yield. So it means that the long end is rising more than the short end. For bear flattening, the short is rising more than the long. For bear steepening, it is the long that is rising more than the short. So in this case, we're going to short this end. I'm going to short the other end because it's a bear strategy. What you have to do is to short both sides so that by the time yields rise, then you'll be benefiting from that movement. So the next thing okay, what exactly does basis point value tell you? I can calculate it, but what does it represent as a standalone? It's to help me understand. Okay, so Alfred is asking, what exactly does basis point value tell you? So basis point value is also the same thing as money duration. It's the same as money duration. So when you calculate basis point value, it's telling me that for every 1 basis point change in the yield curve or the credit curve, what would be my benefit? What would be my gain? For example, allow me to just open Excel quickly. Okay, so I have Excel open now. Let me share my Excel screen. One moment, please. Okay, for example, now my base point value is $29,500. This means that for every one change in the basis points, then the gain I'll be getting is going to be this. So, for example, if there is a base point value of a portfolio is $29,500, if there's a minus two, let's say minus 2% change in the in the curve in the what's it called now, in the yield curve. Yes, in the yield curve. So change in yield curve is this, and then my portfolio duration, let's say portfolio duration is minus 5.7, is 5.7. Then what this means is that how to calculate the gain for you. Remember that how to calculate the present value, change in present value of the portfolio is equal to minus 0.5 duration times the change in yield curve. So in this case, your gain or your loss or the change will be base point value times this times this. Oh, sorry, minus the modified duration times base point value times this. So that means the gain that I'm going to get from that change in the yield curve is $3,360. So it just makes it easier to calculate the change in the portfolio due to change in the yield curve or the spread curve when you calculate basis point value. So it just helps you make sure it brings down the calculation to the minutest information, minutest detail, meaning that if there's a 1% 1 basis point change in the portfolio or in the yield of the portfolio or in the yield curve or in the credit spread curve, then to estimate change in the portfolio, you're just going to multiply that. No, actually, it's minus because to calculate basis point value, we are already using modified durations calculator. So you're not going to, we're actually not going to repeat that thing here. So you're going to just be minus base point value times this. Yes, I remember now. Yes, this is right thing because to calculate the base point value is you're going to multiply duration times market value portfolio times the change. So if you now want to check what is the actual change in the portfolio based on changes in the yield spread or changes in yield curve or credit spread, just say base point minus base point value times the change in the yield curve or something like that. Okay. Okay, is it another question? We can actually understand by knowing when to sell short-term or long-term bond and when to buy short-term or long-term bond. Okay, yeah, I guess so. So back to my slide. I have just like 30 minutes to get to where I'm getting. So I still want us to just review how to answer some mocks before time runs out. So yes, so command words, please get a very good grip on command words are very important. And then build boxes as much as you can, review as many as you can before the exam. Then calculations too, just so even if you have even some questions you've done before, and then you have some time, it's good to just practice them again. Just practice them, just walk through them because it's good to just retain that. And then for constructed responses, so I was saying before, just confirm you can see my slide. Please, can you see my slide? To be sure. Okay, thank you. So when it comes to the essays, please keep it short and simple. If they, as in the shortest we can answer that thing without, well, during my exam, I don't think I wrote up to 3 lines, up to 3 sentences in a lot of answers, just one sentence or maximum two, because they want to just get your answer and move on. Because imagine they're marking hundreds, if not thousands, of scripts, so they don't want to be reading prose or long story. Just keep it very simple. Because so yeah, command words, all of this, so I just put them as just rehash them, and then they are very important to know what it means and how to answer questions. So quickly, let me just I have some mocks open. So last year's mock. So I just want to show us how I approached, answering those questions during the exam. I think it's this one. Okay. Okay, please confirm you can see the mock, the answer, the mock question. Please, can we see the mock questions? Okay. Thank you very much. Okay, let me just go to it. So in this case, the question is asking, so this is goals based asset allocation, goals based approach. So they gave us an exhibit and they said, oh, this investor wants to has 3 goals and they're looking for the best portfolio that will help them to achieve those goals. Goal 1 is to maintain this person's lifestyle and current level of spending for the rest of our life with a 95% required probability of success. So from here, it's based on goal 1, which of the portfolios should we use? So the requirement is to pick the one that has the highest return among that has this within this 95% level of probability of success. So from this, we can see that portfolio A has 4.3%, portfolio B 3.7, portfolio C 4.5, portfolio D 4.4. So for portfolio C is the correct answer because it has the highest expected return for the required probability of success. So then for goal 2, on and on and on. So in answering it, the funny thing that if you look at the guideline response, they will give you a very long story. That's not what you need to do. So for example, let me say how I'll answer it. So for this is my assuming that this is my essay box. So I'll say for goal one, goal 1 is module C. Abi? Yes, module C. Goal 2, for example, let's say module D, I. Goal 3, module A, for example. Then just now say, so determine means that based on what we've given you, choose the right answer and then justify each response. So instead of justifying justification 1, this is it, justification 2, this is that, I'll just say the selected modules have the highest expected returns for each level, each probability of success. And that's it. That's all. This is all you need to get this question right as succinctly as possible. In fact, if I can even shorten this further, I'll just say C, D, and A have the highest expected returns for each probability of success. The examiner will see this and just mark it and move on, because as long as it's correct, I correctly determine the right answer, then and I justify it. That's what I'm looking for. I'm not looking for a long story or for prose, keeping it short and simple. In fact, I can even go further to shorten this by saying for goal 1 is C, for goal 2 is D, for goal 3 is A. Sure, as short as possible. Then number 2, question B said determine the most appropriate change to the rebalancing ranges for the asset classes in Muller's separate portfolio. So let us look at, and then also I'm sure we already know when you're giving a question like this, you read the question first, then you go and look for the relevant the relevant section that's talking about that question. So determine the most appropriate change to rebalancing ranges for the asset classes in my separate portfolio. So it said Mola has a separate portfolio for emergency expenses, which is allocated 50% to equities and 50% to fixed income, and it's rebalanced using a percentage rebalancing approach. Patel examines whether the rebalancing ranges for the two asset classes should be changed. He notes that since the last time the rebalancing ranges were optimized, Muller has become more risk averse, and equities and fixed income have become less correlated. So what they're asking us that what should be the most appropriate change to rebalancing ranges for the asset classes? So the person has equities and fixed income. So it says, should we widen equities? Should we narrow fixed income? And then justify your response with 2 reasons. So here it says that since the last time the rebalancing ranges were optimized, Muller has become more risk averse, and equities and fixed income have become less correlated. So that means that because this person has become more risk averse, then we need to narrow equities because he cannot take more risk. So when I'm answering, I'll just come and say, I'll say equities narrow, fixed income widen because they have become less correlated. Then justification. 1, he is now more risk averse. I'm going to put my answers in red. It's easier to spot. Is now more risk averse. Then number 2, so that's for the equities. And for number 2, Matu says that so equities and fixed income have become less correlated. So number 2 is that 1, equities and fixed income, or let's say both asset classes are now less correlated. Both assets classes have become less correlated. And that's it. Moving on to the next question. So like that, those are the kind of short answer that you need. Then another one, discuss the constraints the Yangs will most likely face regarding the fund investment to which they want to relocate a majority of the portfolio. So it said Patel meets with Bill and Paula Yang, a middle-aged couple with several children who are expected to start college in the next 2 to 3 years. They want to fully fund the cost of their children's college education, $150,000 each. Then they are ready to invest in, but have accumulated an investment portfolio worth that. What's the question again? 2 constraints the Yangs will most likely face. Okay. So primarily consisting of the stock of the company where Bill works. The couple has shown an interest in relocating a majority of portfolio to a private equity fund run by a famous media personality. Paul Patel advises the couple about the significant constraints they will face with an investment in private equity fund. So first of all, because their children are starting college in the next 2 to 3 years, so that means they have a very short investment horizon. And number 2, they're interested in investing in private equity fund. And we know that private equity funds have high minimum investment outlays. So these are the 2 constraints that they're asking for. We've said discuss 2 constraints. So because I said discuss doesn't mean that we should now start narrating a long story. Let me just open discuss again. So see what discuss is talking about. Okay, 1 second. So discuss is just saying that examine critically from various points of view, considering pros and cons and relevant details. even though they've said this one, because we are working with constructed responses, we are looking to keep the text of our response as few and concise as possible. Then we'll just give the required details without being too wordy. So let me just go back to the PDF, to the mock. Okay. So the constraints, number one. So number one, their investment horizon is short as cause their children will be will start college in 2 years. So this is a bit long, but we'll see how to shorten it in 2 years. Number two, they may be unable to meet the minimum investments sum for the private equity investments. So now this is okay. It's not that long, but if you want to shorten it further, you can. But my point is that please let your answers be as short as possible. If you can, I mean, the only thing that you can't use ChatGPT in the exam hall, so you can't tell ChatGPT to just shorten it for us, but you can still shorten it to make it more concise so that you ease the workload on your person that's marking your script. So they'll be able to really read, understand what you're saying, and give you your full score. So now also just look for a question that relates to the portfolio management pathway itself, so that I can just answer some of them. Aha, yes, I've seen. Let's see. Okay, yes, this is exactly what we were discussing before. So we said Nicole Goodwin is a fixed income portfolio manager. So first of all, they said determine which type of credit strategy approach Goodwin most likely employs. Okay, let's read through. Nicole Goodwin is a fixed income portfolio manager for XBK, blah blah blah. Yeah, something that I learned back in classes, that if just don't even forget about the person and where they are working, just move straight to the question, to the case. Because this first line now is not helping anybody. What am I doing with it? I don't have time to waste on somebody's name and where it's working. Just the very clear, the very important fact of the case. So the person is positive on the global economy, one, and believes companies with cyclical exposure will benefit in coming year. She also believes that the market has overreacted to geopolitical events and expects credit spreads to tighten in over the coming year. So, what type of credit strategy approach? Is it bottom up or is it top down? The answer is top down, because she's starting from the global economy and she's now raining down to specific companies. So, in answering this kind of question, we don't have to say the credit strategy approach Godin is employing is top down. No, that's too long. That's too long. What you just need to say is top down. Top down. Why? She is considering the global economy first and the market's reaction. No, a market reaction. Okay, she's considering global economy, um, global economy and geopolitical factors first, ahead of, before narrowing to companies. Okay, so this is fine, but we can even shorten it further by saying she's considering global economy first, and without necessarily saying before narrowing to company, because that is already very clear that we know exactly what we're asking and what we are saying. So this is also very okay. She's also very short and straight to the point. But yeah, we've provided our determination and our justification. Then it said identify one alternative to purchasing individual bonds that SBK traders first. SBK traders should suggest in just one second, please. Okay. We identify one alternative to purchasing individual bonds that the trader should suggest in response to Goodin's question. So John Black, an analyst, shares the view. He identifies three corporate bonds in the industrial sector. Okay, she asks ex-BK's traders for some of the advice, from some ideas on how to gain credit exposure without limiting liquidity, while limiting liquidity risk in a rapidly changing market. So, you know what, we mentioned earlier that you don't have to buy and sell bonds directly. You can just use bond futures. So, an alternative to purchasing individual bonds is be that they should recommend that Goodwin should use bond futures. So, how you can type that, you can respond is just say she should use she should buy bond futures. That's it. That's all. That's all you need to write. You don't need to. This is fine. The person that's marking this knows that this person knows what they're saying. She should buy bond futures. That's simple. Or you can say she should use bond futures. But this is already covered. This already covers the answer they're trying to see. Then C, determine which bond has the highest expected excess credit spread based on Black's expectation for spreads. So remember the formula for excess credit spread. This is the initial spread minus the let me remember, I think initial spread minus the effective spread duration times the change in spread times the POD times LGD. Yeah, that's formula anyway. So after calculating the so you calculate for each of the bonds first, and then after you've calculated them, then you say determine which of the bonds. All you have to say, if it's bond one, say bond one. That's all. Then justify your response. You say it has the highest expected credits expected spread, highest expected excess spread of, I don't know, maybe 340 basis points or something like that. And that's all. Please, I hope we're getting this, because this is actually a game changer. Okay. Someone said, could you show an example with a question asking to analyze? Analyze. Okay, let me search if there's any analyze here. Nah, there's none. No, I mentioned that some particular command words are more commonly used than the others. So analyze, it's not really. I mean, it's in this document. There's no analyze. Let me see. Explain. Okay, let me see. There's explain. So there's no explain also, but there is determine, identify, justify. There is formulate, identify, describe, demonstrate. There is, what else do we have here? There's calculate, interpret, discuss, contrast. There is what else? Determine, calculate, discuss, determine, justify. So some words just appear more frequently than others. So that's just so the analyze is, and for this particular mock, there is no analyze. But if there's analyze in your own, please use analyze. Analyze it very well. So, but in your analyzing, let it be with as short as possible. Then is that response to question C on describe sufficient? So let me see question C. Describe. Where's describe? Describe. I can't see describe. Muhyiddin, can you point to which question exactly? Because I can't see describe. It's just determine. So justify your response. Give sweet answer. Move on. Because in the exam, I'm sure. I mean, you are writing level 3, so you agree with me that it's better to have time after you're done with your entire paper to just go and review. Because sometimes when you're reviewing, when you recalculate something, you'll be like, hey, this is what I did before is not correct. Especially when you are very sure, oh, this is actually supposed to be different from what I calculated before. And it happened to me in my level 3 about 2 questions that I did because I had some time after I finished, about 10 minutes extra, I just went to look through and then recalculate. I just recomputed those things again, and then I saw that about 2 questions. I made sure we did the calculations to be sure that what I did before was wrong, and then I corrected it. So it's best to save time by skipping the name of people and where they are working, responding as succinctly as possible. So that we okay in the first set. Let's see first set. Okay, you mean discourse, Abi? Because I can see discourse. Discourse to constraints. Yes, this is fine. That I say discourse doesn't mean that you should now that we should now start writing paragraphs. This is fine. In fact, no paragraphs as much as possible. If you must talk about many things, just use bullets. But let's be very, very, very short. This is very okay for describe or discourse. It is very okay. Then um okay, please can we do a question with contrast? Okay, contrast. Let me search for contrast. Contrast. Okay, contrast a top-down systematic stock selection approach and Voyager's current approach. So let me just go and look at the question and say that or what's it? On the first business of the following year, Voyager receives new contributions totaling $1 billion. Analyst at Voyager. Oh, this question reminds me of this Leopold guy was managing a leverage hedge fund. Anyway, analysts at Voyager are concerned about the market of blah 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 blah. Blah. As a result, they reevaluate the existing portfolio composition and Voyager's method of allocating to various stocks. The analysts subsequently determined that a top-down systematic approach to a constituting portfolio will be preferable to a current bottom-up discretionary approach. So this is what we covered earlier in the day. So it says contrast a top-down systematic stock selection approach and Voyager's current approach. So Voyager's current approach is okay. So Voyager currently uses a top-down, a bottom-up discretionary approach. So they're asking us to differentiate between contrast a top-down systematic and Voyager and bottom-up discretionary. So how we can answer this is to say a top-down approach so I'm trying to make sure it's really in the context of what they've asked for. Okay. So analysts are concerned about the magnitude of these contributions and the potential. Okay. So a top-down approach. So a top-down systematic approach versus a top-down approach utilizes models and trying to remember that word. 1 second. Okay. Yes. Utilizing model so a top-down approach utilizing model and an objective means of selecting stocks, but a bottom-up discretionary or can we do this way? Top down, hold on, utilizes models and quantitative models, and objective notive approach to select stock or certain stocks. Then bottom up utilizes analysts discretion, judgment, and opinions. It's more subjective than top down. So this is how to answer a contrast question. Just states the key differences between both of them, and that's all. and that's all. So honestly, for me, it was like a culture shock because when one of my tutors was telling us that this is how to answer, he says a lie that you cannot just answer one word and get full marks. That is it. Keep it as short as possible. So we have to go through a retraining process to keep our answers as short as possible. So, and that's what I've learned, and it will also be very beneficial to always think in this way. Try to answer the question in your mind first before you even start typing, so that you know exactly you are limiting your responses to as short as possible. So, I mean, so that's basically it. Trying to see if there's another. So finally, because we were looking at, okay, yes, so a similar example. Aha, perfect. So look at question 2. It said which portfolio would best immunize TM's single liability? So this is a single liability that the person has. The portfolio 1, ABC, they have a single liability. So the cash flow yield, so the liability is due in 5 years, in 7 years rather. So liability is due in 7 years. It's the 200 million liability in 7 years. So among all three, okay. Get 200 million liability during 7 years with a fixed coupon of 5%. Green wants to construct a bond portfolio to immunize this position. So they said which portfolio, that's question 2, which portfolio would best immunize TM's single liability? So the cash flow yield, to the Macquarie duration we are going to look at, because the liability is due in 7 years. So so automatically portfolio C is out because portfolio C's Macquarie duration is 6.0, and that's below the liability period, because one of the requirements is that the portfolio that we're going to use to immunize that particular liability must be at least the same duration. Duration of it must match the year or the tenor of that liability. So automatically C is out. The next thing we're going to look at is the cash flow yield. So portfolio A has 5.1 cash flow yield. Portfolio B has 5.5. Okay, they're a bit that close to 5%. Then the next is between A and B now. And then the average time to maturity for A is 9 years. The average time to maturity for B is 10.5 years. So, and then the last thing is that the convexity of portfolio A is 34 and the convexity of portfolio B is 14. So because of that, because portfolio B has the lowest convexity compared to other ones, then we're going to pick portfolio B. Okay, let me just quickly check the answer out. Make sure I'm seeing the right thing. So that's good. Item set 4. Question A is question 1 is what? Question 2 is A. Okay, yeah. So the answer is actually A, portfolio A, because the important thing is that the macro duration of portfolio A exactly matches the tenor of the liability or the tenor of the liability, which is 7 years. So even though yes, it has a higher complexity, as long as the duration matches the tenor of that liability, then it's portfolio A. Then question 3 now asking that assuming all three portfolios met the other conditions for immunizing a single liability, which portfolio would most likely exhibit the lowest structural risk? The answer here would be B, because B has the lowest convexity. Assuming portfolio A and B had the same Macaulay duration of 7 years each, then portfolio B would have been the answer for A and for question 2 and question 3. However, because portfolio A has exactly 7 years of duration compared to the maturity of the liability of 7 years, then we are going with portfolio A. But in terms of which portfolio will minimize structural risk, then we'll go with portfolio B. Just to put that clearly, and then which of the following strategies will best meet for? Yeah, so that's just all. So that's all. Okay, someone said for a single liability between Macaulay duration and, oh yes, exactly. Muhyiddin, thanks for that question, because that's what we just saw. For a single liability, Macaulay duration first before convexity. As we saw here, portfolio A had the lower Macaulay duration that matches the liability tenure of 7 years, even though portfolio A has a higher convexity. Because that first condition has been met, then the answer has to be portfolio A. But assuming portfolio B also had 7.0 as the Macaulay duration, we are going to go with portfolio B because it has a lower convexity. So that's the answer to that. Lastly, I have just like 3 minutes. Let me just quickly share my last part of my slides. Yes. Okay. Yes. All of this. Sounds simple. Final words that you have what it takes because you've done level 1, level 2, and I are about to write level 3. The next thing that's meaning for you is just to get the chapter. So I really believe in everyone that's on this call and all your friends that was writing level 3. You can get it done and look forward to celebrating you guys when you are inducted at the end of the year into the CFA Institute. So I want to thank CFA Society once again for this boot camp. It's been really insightful for me too. And for everyone that's on the call, thank you so much for participating. And I wish you all the best in your exams next week. I remember you have come this far from beginning. I remember a short story. So me, on the week of my level 3 exam, it felt like the Monday to the Friday, the Monday of the Friday week I was supposed to write, I just had one kind of stupid illness. I'm like, what kind of nonsense is this one? I'm not going to agree with you. Despite the fact I'll be sleeping while reading, I kept I started this in January. It's not that I'm not going to give up. So I just kept pushing. By God's grace, I was able to write. Even though in the exam hall I had my jacket on. I was really hot. I was cold inside, hot outside, but I pushed through. I was going to get this thing done, and by the grace of God, it's done. And I got inducted last year. So the same way, everyone that's on this call and everyone that's attempting this August, I wish you all success and all the best in your endeavors. Come and join us. Thank you so
Thank
much.
you so much, Chukwuka. We really appreciate that. Thank you for your words of encouragement. And thank you for facilitating this portfolio management pathway for the CFA Society in Nigeria. We say a big thank you. To all the candidates that are here, we say thank you for staying with us from the beginning of this revision boot camp till this time. We wish you all the best in your